Okay, hi everyone, welcome. We'll kick things off in a minute or two. I can just see some people still joining now. Everyone joining in Hong Kong. I hope if you went to the sevens on the weekend, enjoyed yourself. You can see some familiar names coming through now. Got a few coming through now. So we might just kick things off today. So thank you all for joining today's webinar. I see got quite a few people joining from a number of locations, so welcome all. As mentioned, for those of you that are in Hong Kong, the Rugby Sevens, hope you had a good time. I certainly did. As a result, quite happy this presentation is today and not yesterday. But look, for today's talk, we'll try to keep it to around 45 minutes or so, some time for Q&A at the end. We encourage the questions, and you can ask these questions in the box here at the bottom at any time. As mentioned, we'll get to as many of these as we can at the end. We've also had plenty of questions come through in the lead up to, so we've actually tailored some of today's presentation to speak to these topics best we can, and we can answer a few of these questions at the end as well. So today's session will be recorded, and we'll be in touch with everyone following today's webinar as well with a copy of that recording and the slides. Okay, so I'll be joined by Sean Rattray of Aussie Expat Home Loans today in the second half of this webinar, but a little bit about me. Nice big picture there. As you can see, I've been in the financial services industry for over 10 years now in a number of different roles. I've worked within the banking industry at Macquarie in Sydney, along with a number of independent advice practices in Australia as well. I moved to Hong Kong about 8 years ago, and I've joining Oriana Private Wealth as a senior advisor. I'm dual licensed both in Australia under our AFSL license and Hong Kong with the SFC, IA and MPFA. So this allows me to provide holistic advice for clients both in Australia and for international advice and planning matters as well. We provide bespoke financial advice for clients for a range of needs and different circumstances based in locations around the world in some cases. So for our clients on the line today and anyone that watches Bloomberg and any other major investor news outlets, you'll know that Oriana have a world-class institutional investment capability. It's led by Dr. Isaac Poole and his team. I'm, of course, supported by the team, which allows us to ensure our clients are also achieving optimal outcomes from an investment perspective, as well as making the right financial decisions and putting in place the right strategies in line with goals and your individual circumstances. So today I'll be speaking about the Australian federal budget, giving a rundown on some of the noteworthy updates, insights into a few of the key measures announced, finishing off with some strategies and planning opportunities for expats and non-residents to potentially optimise your financial outcomes. Oops. So the Australian federal budget was handed down by the Treasurer, Jim Chalmers, on Tuesday last week. Being an election year, it was always going to be interesting as the current Labor government aimed to balance spending while trying to appeal to voters. There were some surprise tax cuts this year for Australians, along with some important measures, both announced and unannounced, which I will explain, with some of these potentially affecting expats. So I'll speak to these during the presentation. So kicking things off, at a high level, the economic indicators for the Australian economy do look encouraging. As we know, the global economy is facing considerable uncertainty and growth is expected to remain subdued over the next few years. However, growth did pick up in Australia at the end of last year, and the momentum is expected to continue to improve with real GDP forecasts over the coming years up to 2.75%. The unemployment rate is forecast to steady at a peak of 4.25%, which is a quarter of a percentage point lower than previously forecast, which is a good outcome. Strong labour market conditions and moderating inflation have led annual real wages being forecast to continue to grow faster than inflation, the latter having moderated considerably with CPI at 2.5% here. It's really important, I think, for wages to be growing at a faster rate than inflation for an economy, and it's good to see that this will hopefully be the case with years to come, with inflation back in line with the RBA's target level. So overall, these indicators, along with interest rates in Australia slowly easing, I think are all relatively good signs for the economy, particularly given the current global economic backdrop. And importantly for households in Australia, feeling the pinch of increased living costs currently. So in terms of the budget outcome, in summary, the budget resulted in expected deficit of 1.5% of GDP or $42 billion, forecast for 2025-26. This is actually an improvement from the recent mid-year economic and fiscal outlook, which is another good sign. The federal government net debt is expected to remain reasonably stable as a percentage of GDP, between 21 and 24% over forward estimates. The deficit was partly a result of the Labor government, I think, carrying through those stage 3 tax cuts last year that you may recall, which came at a large expense for the government, along with further tax cuts this year and some spending initiatives announced this year as well. As mentioned, though, I think the outlook for the Australian economy does look relatively okay from some of these forecasts and key indicators. However, while the government has aimed to remain responsible with this budget, is key to understand that these higher levels of gross net debt that you can see here will eventually have to be paid for in the future, either through higher taxes or lower spending. So, of course, this is something we need to perhaps be aware of as returning expats or for those thinking of moving to Australia. Okay, so some of these key initiatives that are announced being an election year, you can often see something potentially aimed at grabbing some additional votes at the polls. This year was no different. I think one of the main talking points this year were the surprise tax cuts, mainly because this will affect all Australians, although not non-residents this year due to the tax cuts being at that lower rate, lower resident tax threshold. However, the cuts, they weren't huge in the hands of taxpayers, but they did actually come at quite an expensive measure for the government. On budget night, the numbers quoted were, I think, in a couple of thousands of dollars, but it actually works out to be $268 per year, increasing to $536 per year next year onwards. The tax cut numbers spoken to on the budget night were actually the numbers that included those stage 3 tax cuts carried through from 24-25. Excuse me. So it's an interesting way to wrap things up there. But these stage 3 tax cuts that came into effect this financial year do affect non-residents, and I'll speak to these in the coming slides. Other key initiatives announced were focused on cost of living relief measures mostly. These included spending on energy bill relief, cheaper medicines, incentives to increase bulk billing, strengthening Medicare, which I think were all good measures for Australians. There were no major changes announced for aged care. However, there are some changes to be aware of coming into effect from 1 July. Residents entering residential aged care from 1 July may need to pay a means-tested hotelling contribution up to $13.46 a day. This fee is payable if the daily means test Tested amount exceeds the maximum accommodation supplement. That's $69.79 per day. Residents entering aged care from 1 July 2025 as well will also pay a means tested non-clinical care contribution. And if the daily means tested amount exceeds the sum of the maximum accommodation supplement and maximum hoteling supplement, this fee will be capped at $101.16 a day. So there's also some changes for the accommodation costs for residents entering from 1 July as well, new fees for the supported home program. So it's quite a complex area. Requires careful planning. So perhaps not for everyone on the line, but maybe for your parents. So if you'd like assistance in this area, just reach out to us. So one very interesting measure this year, which does potentially affect younger expats on the line today or those with children studying in Australia with help debt, is the student debt relief. This was a one-off reduction of 20% of all outstanding student debt announced this year in the budget. The ATO will apply the reduction automatically on all help balances from 1 June 2025 before the usual indexation is applied. On help debt, the government actually increased the debt repayment income threshold to $67,000 as well. Additionally, the repayment rate will also be calculated as a marginal rate for 1 July 2025, moving from total income. So this will actually be a pretty significant decrease in payments based on global incomes for any expats that are still paying off student debt as well. Excuse me. In terms of housing affordability, the government is looking to launch the Help to Buy shared equity scheme in late 2025. This is an initiative where the government will provide up to a 40% equity contribution to support eligible home buyers. That purchase, eligible home buyers that purchase a home with a lower deposit and a smaller mortgage, with contributions being able to be bought out over time from the government. There's, of course, price caps in place for state and capital cities, along with yearly income caps and other criteria to be aware of. However, this may potentially be relevant for any returning expats eligible looking to buy their first home. The government also plans to instate a ban on foreign buyers, including temporary residents and foreign-owned companies, from purchasing existing dwellings for a period of 2 years from 1st of April 2025. Additional funding will be provided by the ATO and Treasury to enforce this ban and the target, and also to target land banking by foreign buyers to ensure that vacant land is put to productive use within a reasonable time. And then finally, the tax residency elephant in the room. Again, there was no mention of the proposed changes in tax residency in this year's budget. However, I'm still quite confident the planned tax residency overhaul will come into effect at some stage. And I think there's a risk that this may potentially be at short notice as well, given the lead time that this has had since being originally announced in the 2021-2022 budget. So as most people listening today, the proposal is to change the current residency test. The current test is basically anyone that spends 183 days in a year in Australia is deemed to be a resident for tax purposes if they also meet other criteria as well, such as having longer term plans to stay in the country. The current residency rules are more or less based specifically on intention to live in Australia. However, the proposed bright line test introduces much stricter rules, with the changes stating that anyone who spends more than 45 days in the country can be deemed an Australian resident if they have specific ties to Australia, including family, business, or other assets. This may have obviously significant tax implications for anyone that may inadvertently be deemed an Australian resident, which could see you subject to worldwide tax on income and capital gains at marginal tax rates up to 47%, including Medicare. So while we're on tax, just an update on the current tax rates and some of the changes coming through for the current financial year and coming financial years based on the budget announcement. So at the top here, we have the Australian resident tax rates. Australian tax rates are marginal and they increase with taxable income, which may include income, or earned income rather, or capital gains. With the changes in tax rates announced in this year's budget, these are in relation to the 18,200 to 45,000 per annum bracket there. You can see decreasing from 16% to 14% over the coming years. As mentioned, these tax cuts won't affect non-residents, given we're subject to higher non-resident rates. But you can see here, the second table on the bottom, these non-resident rates predominantly apply to non-resident investors in Australian real estate. So basically, non-residents subject to a higher tax rate threshold on any taxable Australian sourced income. So just in summary here, I've just included the 2023-2024 rates on the left here to recap on those stage 3 tax cuts that I mentioned that came into effect for this current financial year. So these stage 3 tax cuts actually do affect us non-residents, as the first tax threshold has decreased from 32.5% to 30% this current financial year. That upper tax band for this income tier was also increased from 120,000 to 135,000 per annum. So there's a reduction here for anyone that's paying tax on their Australian rental income or capital gains, etc., when you go to lodge your Australian tax return this year. Although there are plenty of planning opportunities that non-residents can consider here to be mitigating their tax outcomes. So I'll go through these in a moment. Okay, superannuation changes. So superannuation has been a somewhat contentious topic, given 3 years ago, Albanese, it was clear that Labor had no intention to make changes to super. However, with Division 296 being announced shortly after in early 2023, also known as the 3 million super tax, there was some pretty widespread outcry over this broken promise. This was introduced to Parliament in November 2023, and it seeks to impose an additional 15% tax on members with $3 million or more total super balance, and this is not indexed. As mentioned, there was a fair bit of criticism about this bill, partly in the way I think how it was introduced, but also due to the fact that it aims to tax unrealised gains, which can be quite punitive for those who are subject to this tax. There's no mention of this at all in the budget, which basically confirms the government is set to continue to set this tax measure into force despite the backlash, I guess, it's received. The Labor government will take this to election, although whether they can manage to get this through or not is probably another question. So I guess we'll just have to wait and see on this. Although further, I guess, with changes here that are notable, there's been a slight change to the super transfer balance cap. This is the limit to total amounts of superannuation that can be transferred into the retirement phase, basically from accumulation phase where there's 15% tax on income and CGT to tax-free pension phase. The total amount that can be transferred will be indexed from 1.9 currently to $2 million from 1 July 2025 for those that are yet to implement an income stream or a pension from their superannuation. So yeah, given the 15% accumulation taxes to super, to balances above 2 million and potentially a further 15% tax for balances above 3 million, you may want to think about additional planning opportunities that may be available. So if this is you, come and speak to us. And finally, in terms of super contributions, these caps were indexed from 1 July 2024 to 30,000 per annum for concessional, and 120,000 per annum for non-concessional contributions. So these caps will increase again from 1 July 26. So just to be aware of that. Okay, so in summary, I think the key considerations for the budget this year for expats, tax. So expats should monitor their progression of the tax cuts and superannuation. Property, there was a help to buy scheme. Also rates this year, didn't touch on it too much, are likely on the way down, which will assist borrowers. I'll leave this part to Sean. Families with children in Australia should be aware of help debts, or those in the line as well. And superannuation, I think most importantly, just to be planning contributions strategically to maximise, take advantage of the caps, and also just considering other planning opportunities that may be available to complement an effective super strategy. So on to the planning side of my talk today. Firstly, we received a lot of questions, it seemed, on how property is taxed for non-residents by registrants today. So there have been quite a few changes in this space in recent years, so obviously it's understandable. So mentioned, I guess in terms of tax rates, as mentioned, they're quite different for residents versus non-residents, but also the way property is taxed varies significantly as well. So as I guess as discussed, the tax rates are higher for non-residents, but there's some of these other aspects to be aware of. Just got a simple comparison here. On the left, you can see you can sell your home fully exempt from any capital gains tax as an Australian tax resident. Also, selling an investment property that has been owned for more than 12 months. It's actually all assets as well, basically, receive the CGT discount, where you'd be taxed at marginal tax rates, but less that 50% discount on the total amount. And then also net rental income generated is assessable, is deemed assessable income at Australian marginal tax rates. On the right-hand side here, more relevant for everyone here today, you've got the tax treatment for non-residents, as mentioned earlier. Even though your shares and other assets might not be taxable by the ATO or you're a non-resident, Australian real estate and property is. Um, so for Australian expats, this includes your home in Australia if you do sell it while you're living abroad. It also, of course, includes investment properties as well for all investors outside of Australia. Um, and importantly, to understand, in addition to this, you won't be eligible for any CGT discounting either. Um, Finally, here, net rental income is taxable at non-resident rates, which I'll speak to. So yeah, I guess some planning tips here. Generally, it's best to try to avoid selling Australian property while you're a non-resident for Australian tax purposes. There are some mitigation strategies there, but broadly, the 6 year rule on homes and CGT exemption for Australian citizens and permanent residents. In summary, you can sell your principal residence as tax-free as an Aussie resident, as mentioned. However, you're not eligible as non-residents to claim this exemption. This rule changed in 2020. However, after moving to Australia or being deemed a tax resident, you may be able to again claim that 6 year exemption if you do sell it, following becoming an Australian tax resident again. Uh, Interestingly, this exemption may also be applied for an overseas home as well. However, there's some important factors there that need to be considered. So best you come and speak to us first. 50% CGT discount as well, as mentioned, maximising deductions, maintenance, upkeep, land tax, strata fees, etc., all typically taxable expenses, of course, loan interest for later borrowing as well. And then concessional contributions to superannuation can be tax deductible. Also, importantly, carry forward losses, negative gearing, costs on Australian properties that are not used and accumulated while you're offshore can also be used to offset Australian taxable income and CGT as well, which I'll go through a little bit further now. So as mentioned, investment debt is tax deductible against Australian taxable rental income, also capital gains. So understanding and implementing the right strategy in relation to the levels of borrowing or gearing, as we refer to, for your circumstances is important to achieve the best outcomes in relation to your investment strategy. So positive gearing is where rental income is more than the cost of borrowing or other expenses. This is great because you get to enjoy the income. However, it will be taxed at either of the below rates, depending on your residency, which can be quite punitive. Secondly, you have here neutral gearing. So this strategy here being the rental income funds ongoing costs evenly, essentially. The strategy here typically being that you look to make a profit at the sale without impact to your cash flow during this period. However, you will need to manage the capital gain tax, of course, if you do sell it. Timing here is obviously key, as mentioned. And then finally, negative gearing, which is a common strategy for investors offshore. In this method, the rental is less than the costs, although the negative tax loss can be accrued each year and carried forward to offset future income or CGT at a later date. So rather than saving tax on rental at the 30% tax bracket as a non-resident, you can accumulate these credits to be used to offset tax at these higher tax brackets, either at the time of sale or even Australian taxable income, including employment income or other taxable income upon moving back to Australia. Um, so mitigating tax strategies using superannuation. So keep in mind that as an Australian tax resident, assets are taxed worldwide with common reporting standards these days. There's nowhere really to hide your assets. So best to think about how your investments are structured. So for anyone that may not be familiar, superannuation is a retirement scheme in Australia. It's much like MPF in Hong Kong, CPF in Singapore, and so on. And super has its own tax environment, where essentially it's sheltered from Australian marginal tax rates, much like a trust, or essentially it is. Um, as mentioned earlier, superannuation tax rates are typically 15%, with discounts on capital gains, benefit of franking credits, imputation credits, and so forth. You can reduce income down to 10% and CGT as well. Superannuation it's great, particularly if you have or you are approaching to retirement, and it typically forms the cornerstone of Australian-based retirement strategies for most. Um, However, as mentioned earlier, there are contribution caps to be mindful of. So you do need to plan ahead. Concessional contributions, as mentioned earlier, these are tax deductible. Pre-tax contributions up to a maximum of 30,000 per annum currently, which not only provides tax deduction, but it also contributes or invests those contributions in this tax effective environment as well, compared to Australian marginal tax rates. However, obviously $30,000 per annum, you can't really move a lot in one go there. So you also have non-concessional these are after-tax contributions, can allow larger amounts of cash, assets, even property. Different strategy has to be managed, but can allow these larger contributions to be made with capital being invested in a more tax efficient environment. Up to 120,000 per annum the current year, with the ability to do 3 years in one go. This is utilising the bring forward provision. And yes, non-residents typically can make contributions to super. So just ask us to find out how. And then I guess the eventual goal here is from age 60 and retirement, you can basically draw an income stream from superannuation, which is completely tax-free in Australia. Further to this, obviously the income and capital gains within the super fund are also tax-free in pension phase. So this is a really tax-efficient way to structure your assets and fund your retirement in Australia. Superannuation is, excuse me, the most common strategy, I would say, to build or restructure your assets tax efficiently for retirement in Australia. However, with those caps on contributions and also including the transfer balance cap that I spoke about earlier, currently 1.9 million, increasing to 2, along with restrictions to accessing capital and meeting preservation age, which is currently age 60 and retirement, or age 65 regardless of retirement. You do need to plan carefully. Although for those offshore, there is another string to our bow that we can look at as well. So offshore, there are a number of planning opportunities available for clients and investors as well. So the first one here is private placement life insurance, or commonly referred to as portfolio bonds. PPLI, or private placement life insurance, it's a sophisticated form of insurance wrapped investments, which essentially receive concessional tax treatment by the ATO, subject to specific guidelines. This can be a really tax efficient and quite a low cost strategy to build and structure wealth if set up correctly. Typically for liquid investments, including stocks, ETFs, funds, bonds, etc., contributions are initially uncapped. So really for these, for large balances as well. And then subsequent to that first year contribution, there are specific mandates around subsequent contributions, which are basically 125% of that immediate previous year's contribution. So quite specific mandates there, but that first year contribution is uncapped. And importantly, the way that the tax treatment works is that these bonds or private placement life insurance is effectively tax deferred, and then for the first 10-year period, and then following an initial 10-year period, completely tax-free. So withdrawals, whether that be an income stream, lump sum, or simply continuing this strategy, is completely tax-free. Excuse me. So a relatively low cost tax wrapper strategy for anyone, I guess, that are more than 10 years away from accessing their super, or as mentioned, have wealth above those superannuation caps, precluding them to structure their assets tax efficiently. A really good strategy there. Essentially, offering that additional option for those looking to potentially move to Australia or become Australian tax residents. And I guess actually I didn't mention it, quite importantly, technically as a life insurance product, it also offers some fantastic legacy planning benefits as well. And then secondly, foreign super. So this is essentially an offshore trust structure, which meets foreign super definition. Open architecture, meaning almost any asset can be transferred in. Again, we've got uncapped contributions. Important to note, withdrawals are allowable from age 55 rather than age 60 compared to Australian super. And the initial capital can be drawn tax-free. So there are ways to create significant tax efficiency there as well, with earnings being available to be rolled into Australian super as well, if that fits into the strategy. So, look, in summary, I would say often a combination of managing gearing on property purchases, maximising eligible super contributions, and where appropriate, implementing offshore structures. You can really optimise the tax efficiency of your financial situation and wealth creation strategy leading up to a potential move to Australia, or if those proposals come into effect, becoming or being deemed an Australian tax resident. So that's it from me. My voice was starting to break a little bit, so I'm very happy to be throwing to Sean now from Aussie Expat Home Loans to run through his section, and then we'll open it up at the end for some Q&A. Thanks, Sean.
Great. Thanks, Maddie. Appreciate the kind intro, and yeah, sounding a little bit more raspy than usual, mate. So, you know, the sevens must have treated you well. Can I just confirm, Matt, that you can see my screen?
I can.
Beauty, mate. Thank you. All right. Well, look, let me kick off by introducing myself. So my name's Sean Rattray. I'm a mortgage broker based up in Hong Kong. Been up in Hong Kong for the last 6 years. In a previous life, worked for Commonwealth Bank's private bank up here in Hong Kong and back in Australia as well, with CBA for 14 years in the end. The business up here has been running since 2018, founded by Tim Rays, who's another ex-private banker, worked for NAB in Singapore. We've got 3 offices now in Singapore, Hong Kong, and Melbourne. And our main aim of our business is to serve the expat market. So being placed in Asia, that allows us to meet with you up here offshore, but we do have clients all across the world. It's a bit of a minefield for expats looking to access lending back in Australia. So, you know, it's a business that Tim saw a need for a few years back, and yeah, it's going quite well. So look, let's kick off with a bit of a round the grounds with the Australian home prices over the last 12 months. So we've seen a 3.8% growth in home prices on a national average basis. So while this is still up, it is actually the lowest uptick in dwelling prices since the 12 months to Feb 2023. So regional centres have continued to outperform the capitals. We're seeing a lot of buyers chasing these regional investment properties rather than the capital cities, due largely to stronger rental yields and greater capital appreciation from a lower base. Now, the current forecasts are for a slower growth rate over the coming 12 months, which is driven largely by affordability pressures back home. So Brisbane, Adelaide and Perth, they remain the strongest centres for capital growth, as well as in the regions. WA shot the lights out with a 15% combined growth rate year on year between the regions and the capital. We're seeing some extremely strong rental yields coming out of Perth, Metro in particular. So having said that, I would consider entering the Perth market being very well informed. Of the major centres, Perth has seen the most boom and bust over the past couple of decades. On the other side, you know, Melbourne has seen the lowest return over the past 12 months with a 3.2% retraction in property prices. Now, having said that, there is some consistent messaging that Melbourne is underweight at the moment, and it is a strategic buyer's market. So land tax, stamp duty, state government uncertainty has kept buyers away from the market and has kept the market quite flat. So Melbourne is still tipped to be the most populated city by 2032. It's got the highest net migration of all the states in Australia, and there's plenty of room to grow. So we're hearing more and more from buyers agents who are pivoting to Melbourne and Victoria to capture some of that soft pricing and lower clearance rates. Now, in the budget, the government has committed $33 billion to build more homes in Australia. So if executed as promised, this should do work to ease the housing shortage in Australia, which is placing pressure on the market. Other updates in the budget, as Maddie touched on, was around the shared equity scheme. Look, this is probably more strategic for clients who are looking to repatriate back to Australia, as some of the conditions to access this scheme would require you to live in the property as a principal place of residence. So certainly a discussion we could have if your plan was to move back. But if you are up here as an expat, this is probably going to have little impact on your capacity or direction. Okay. The other thing as well that Matt touched on also was on the 2-year ban for foreign investors. So this doesn't extend to Australian expats or PR holders. This is just for people who have no connection to Australia, who want to buy an existing home. So this isn't a new policy. If anything, it's just a bit of an extension of an existing policy. And these foreign buyers, they only make up a very small proportion of Australian homeowners. So we don't actually see a whole heap of pressure being put on the market by this segment of purchases. So not too much to worry about. And if you are an Aussie expat, it's not going to impact your access to the market. Okay. So yeah, the recent rate cut that we've seen, which I'll talk about in a minute, we've seen a surge in pre-approvals on the back of that. As the interest comes back into the market, we can expect some of these centres to continue to heat up. Now, in terms of rates, so the Feb meeting saw the first cut since 2022. Inflation currently sits at 2.4, which is within the RBA's target bracket of 2 to 3%. The RBA dropped the cash rate by 25 basis points, so it came down from 4.35 to 4.15. The market does expect further movements downward this year. There is continued messaging for Australians not to expect back-to-back cuts, which we have seen today with the RBA holding at 4.15. The RBA, in saying that, does forecast rates to hit the cash rate to hit 3.2% by mid next year. So we can expect rates to continue to fall. So as you can see from the table on the slide, the major bank economists do see rates coming off further this year, with every bank agreeing that there'll be at least one additional cut. Other banks believe there'll be more. We can expect that, as with the market being so high, the interest rate market being so high, we could expect that the bank should be passing along the full reduction. But in saying that, we have seen lenders in the market, even with this first cut, not passing along that full reduction. Okay, so what will this mean for you as an expat borrower? So it will mean cheaper lending to start with, which is the big win. But on the other side, it will also mean greater borrowing capacity. So as the rates drop, so do the assessment rates that the banks use, which is the stress test, to make sure that if rates were to increase, you could still afford your lending. So as it currently stands, banks generally use between 2 and 3% as an assessment rate. So if rates are currently sitting at, say, 6%, they'll be measuring your ability to service that debt on around about 9%. So as these rates continue to drop, so will the assessment rates, which just means more capacity for you. Okay. Now, let's drill down a little bit further on the rates. So we are seeing rates for investors as low as 5.94 at the minute. For owner-occupied, we're seeing it down around 5.85. Two key elements to consider here when trying to get the sharpest rate for your home loan. One being the loan-to-value ratio and the other being the debt load. So in essence, the lower the loan-to-value ratio and the higher the debt load, the sharper the rate. So the sweet spot that we're seeing at the minute is around about sub 70% loan-to-value ratio with a debt load of greater than $1 million. So we do have lenders on our panel that, or most lenders actually on our panel, will go up to 80%. So if the deposit plus costs, your ability to tip in that deposit, which is only 20% plus costs, most lenders will still allow you to lend up to 80%. But as I say, if you want the sharper rates, then you'd want to go a little bit less. On the same note, if you needed to go higher than 80%, there are some lenders as well that will allow you to go up to 90 or even a little bit higher. But then we're getting into the territory of lender's mortgage insurance, which can be quite expensive. Okay. In terms of fixed rates, we're seeing some healthy fixed rates at the moment, like you can see on the screen. 2 and 3 year rates, 5.49 for owner-occ, 5.64 for investment. In saying that, fixed rates aren't really in vogue at the moment because the general sentiment is that rates will drop. As rates drop, you're going to see your variable rates drop with them, you would hope. So really into these rates that you can see on the screen, there's only maybe 1 or 2 further rate cuts built into the fixed rates. So we're not seeing a lot of people fixing at the minute. Okay. Now, in terms of cashbacks, there are a couple of lenders that are offering cashbacks at the moment. During COVID, there were a lot more trying to win business across, but at the minute, there's not too many. We're hoping some more will come back into the market. And there are some particular circumstances as well where if your servicing is very, very strong, even when you are an expat, there are ways for you to still access owner-occupied rates. So look, that's a discussion that we will have as brokers with you if it does suit at the time. But just know that there's certain mechanisms that we can employ for you to be able to get the cheapest deal. Now, one thing that I would call out is that Virgin Money, if you are a mortgage holder with Virgin, it's certainly worth reaching out because they were one of the only banks that didn't pass along the interest rate reduction. Virgin did a lot of work for expats in the last couple of years. They were a lender of choice at one point, but unfortunately, with this recent drop in Feb, they didn't pass along any of that. So it's almost a guarantee that we could get you sharper rates if you opened a discussion. Okay. Now, tips and tricks. Things to call out, things to be conscious of, okay, if you are looking to get into the market as an expat. I'd say the major one is just to reach out early, yeah? So obtaining a pre-approval can take a little while, especially when you're an expat. We can try and make it as fast as possible. We can escalate with the lenders, but in general, it does take longer than if you were a domestic applicant. So what we normally say is we'd suggest up to 2 weeks from the time we submit, but usually it will come in quicker than that. Okay. Now, it's a good rule of thumb to consult us before you make any major changes in your circumstances, be that moving back to Australia, starting a new job, moving work location, or earning a new currency. What we can do in those situations is try to get our ducks in a row as best we can, look at sharpest rates for you before these changes take effect, or structure things that will be most effective for you, because sometimes once these changes have been made, it does exclude you from borrowing for a period of time. So it's always worth, if you've got a relationship with a broker or you start one, say with us, then just reach out if you've got any plans and we can have that chat. Now, if you are also considering going self-employed, which a lot of expats tend to do, would be that move into consulting work or be a sole trader, that will have an impact on your ability to lend. So once again, just reach out if that is the case. Now when you are buying from abroad, it can be challenging. So, I bought a few years ago for the first time, and it's tough even to find a real estate agent who will pick up the phone. I think in Australia, they're accustomed to seeing Australian numbers, and if you see an international number, it can put you off. So something as simple as that can be a real barrier of entry for you to access the market. So we do have some clients that will have pre-approvals, and with a pre-approval, you can roll every 3 months. Completely fine from our perspective, but a lot of the time clients just find it difficult to access property opportunities. So one consideration there is the buyer's agent channel. We work with a lot of great buyer's agents who find off-market opportunities and who can really open doors that you mightn't have thought were there previously. So that's something to consider for expats who are finding it a little bit tough. Just that buyer's agent channel. Conscious of time, so I'll try and keep it nice and quick. The other thing I'd probably say is equity, accessing equity. So if you do have an existing property in Australia and you have equity in that property, or it hasn't been looked at for a little while and you would like us to check if there was equity in that property, that can be an effective way for you to be able to cover the costs of purchasing your next investment property without you having to tip in much or any cash. So many lenders have relaxed their policies around accessing equity in properties in Australia. So, definitely worth a chat. The other thing, last one, is just on the lazy tax. So the lazy tax concept is when you don't check your rates for a long period of time. Banks love to stitch you up if you don't review it semi-regularly. So when you take a new loan, you're likely to get the sharper rates than if you just sit with your current bank. So always worth checking in with your bank at least once every 6 months, just to see whether or not there are any sharper rates that they can give you. Look, general rule of thumb at the moment in the market, if you're paying more than 6.2, it's very likely we could probably get you a better deal. So first port of call, reach out to your bank, have that discussion, see if they can do any better. And if they can't, or they're being difficult, then just reach out and we can have a chat. Okay. Well, look, in the interest of time, I think I'll leave it there. Thank you all very much for your time. And I think we'll open it up to Q&As now, Maddie, if that's correct.
Yeah, sure. So thank you, Sean. Pretty exciting time, I think, to be looking at either your debt or property and seeing if these guys can get you a better deal. All right. So yeah, look, 5 minutes left. So a few questions that came through here. which I think we answered probably most of these already during the talk. But can I claim negative tax losses if I don't sell the property? So yes, you can. You can use tax losses to offset rental income, or if you have positive net rental income, i.e., you're paying down the loan over time, and go into that sort of positive gearing position that I spoke to earlier. You can also offset Australian income after becoming an Australian tax resident again or in the future. For instance, employment income, other investment income, etc. Uh, okay, so I've got one here. After working overseas for a few years, when I return to Australia, if I sell my owner-occupied premise, am I still able to be exempt from the CGT? So, yeah, we did cover this. It is possible to a degree. So, if you are within that 6 year window, and it was originally your home, and you return to Australia, selling a home as an Australian tax resident again, then likely the answer here is yes. You cannot claim another property as your home during this period. However, if you do sell it outside the 6 year window, you still may be able to claim that 6 year period, apportioning the tax there. Were there any updates to proposed changes to residency rules? As mentioned today, there was not in this year's budget or last year. There has still been a lot of chat, though, although I think the last formal update was the consultation paper in September 23. Yeah, look, it's challenging when there's not a lot of clarity on this. So I would just suggest having the right planning in place for this. There was also a question about opening a super account as a non-resident and investing 360,000 in mutual funds tax efficiently at age 74. Okay, so this question is about making non-concessional contributions to super, utilising the bring forward provision that I touched on today, with the ability to make 3 years worth of contributions in one go. The answer here is yes, up to age 75 though, so you better reach out soon. Also, there is the transfer balance cap to be aware of that I discussed. It's currently 1.9 million. So you can only make non-concessional contributions while your balance is below this cap. Once you're above that cap, you will be precluded from making further non-concessional contributions. So you may need to look at some of those other strategies there. A couple of minutes left, Sean. Did you have any there? I'll throw back to you.
Yeah, mate. Thank you. So, yeah, I've received a good couple of questions here. So, one around how lenders manage foreign currency risks. So, this is the weird and wonderful background to all the different lending, directions that the domestic banks have for expats. But generally, what they will do is they'll sensitize your income. They'll take a specific haircut, be that 20% all the way up to 40%. Some will charge, or some will calculate based on Australian tax rates, even if you're in a low tax jurisdiction like Hong Kong. Others will take local tax rates. So it can be very favourable for the low tax jurisdictions such as Hong Kong, Singapore, or the Middle East. So, that's our job to assess the effectiveness of each lender. So, we'll give you a comparison based on that. The other thing that lenders will do as well to mitigate some of that risk is to offer lower LVRs or loan to value ratios. So some lenders may only go up to 70%, where other stronger lenders, some of the majors, might go up to 80, 90%, 92%. Another question, which was an interesting one, was on the Airbnb market in Perth or Australia in general. So this is a little bit of a minefield, and it's an evolving beast. So each state seems to be bringing in their own ruling around how you're taxed or how it's looked upon by having these short-term rentals. For example, has a 90-day rule maximum annually that you can do a short-term rental, whereas other states such as Victoria will charge an additional tax on the income earned from short-term rental of 7.5%. So, there's some weird and wonderful changes coming through, but can be very effective and in a high yield environment, which Australia can have. If you purchase the right investment, then you can get some really favourable outcomes. Okay. Thank you.
All right. Well, look, that's 1 o'clock now here in Hong Kong. So we will let everyone get back to work or where you need to be. Thank you again for joining Sean and I today. As mentioned, we'll be in touch with the slides and the presentation from today. So look out for that. Thank you again, and enjoy the rest of your week.
Thanks,
Bye now.
guys.